Investing is often seen as a game of numbers. We analyze charts, study trends, and pore over financial statements. Yet there's a hidden force that can sabotage even the most diligent investor: confirmation bias. Imagine this: you hear a tip about a hot new stock. Excited, you start looking for information online, but here's the catch. You're naturally drawn to articles and forums that confirm your initial positive impression. You skim over or even dismiss any negative news or critical analysis. This, my friends, is confirmation bias in action. We tend to favor information that confirms our existing beliefs while ignoring or downplaying evidence that contradicts them. This bias can have significant consequences for our investment decisions and ultimately our financial well-being. Confirmation bias operates through selective exposure, selective perception, and selective retention. Selective exposure refers to our tendency to seek information that supports our existing views. We gravitate towards news sources, analysts, and even social media groups that reinforce our beliefs. Selective perception kicks in when we encounter information. We tend to interpret ambiguous data in a way that aligns with our preconceived notions. Finally, selective retention ensures that we remember information that supports our beliefs more readily than information that challenges them. These mechanisms create a powerful cognitive bias that can lead to poor investment decisions. Confirmation bias fuels a cascade of behavioral pitfalls that can wreak havoc on our investment portfolios. Overconfidence leads us to overestimate our abilities and the accuracy of our predictions. When we constantly seek out information that confirms our beliefs, we create a false sense of certainty. This can lead to excessive trading, concentrated portfolios, and ultimately significant losses. Herd behavior plays on our innate desire to conform. When we see others investing in a particular asset, we're more likely to do the same, driven by a fear of missing out, FOMO. Unfortunately, herd mentality can lead to asset bubbles and market crashes. The combination of overconfidence and herd behavior is a recipe for disaster in the financial markets. History is replete with examples of confirmation bias fueling market manias and subsequent crashes. The dot-com bubble was driven by irrational exuberance for internet-based companies. Investors, blinded by the transformative potential of the internet, poured money into any company with a .com suffix, regardless of their underlying fundamentals. When the bubble burst, billions of dollars were wiped out, leaving investors in ruins. The housing market crash of 2008 provides another stark example of confirmation bias at play. The belief that housing prices would continue to rise indefinitely became so ingrained that both lenders and borrowers ignored obvious warning signs. When the bubble burst, it triggered a global financial crisis, highlighting the devastating consequences of unchecked confirmation bias. While we may never be completely free from confirmation bias, there are practical steps to mitigate its influence. Cultivate skepticism towards your beliefs. Question assumptions and seek dissenting opinions. Embrace diverse thoughts and surround yourself with challenges. Implement structured decision-making, define goals, establish criteria, and consider risks. Manage risk effectively. Diversification helps. Engage in self-reflection and seek professional advice. By adopting these strategies, we can become more aware of our biases and make informed decisions. To combat confirmation bias, we need to delve deeper into the psychological underpinnings. Cognitive dissonance arises when we hold conflicting beliefs, creating mental discomfort. When our beliefs are challenged by new information, we tend to cling to our initial views. Emotional attachment can cloud our judgment and lead to poor investment decisions. Understanding these tendencies is crucial to overcoming confirmation bias. Confirmation bias poses a significant challenge to investors of all levels of experience. Its pervasive influence can lead to poor decision-making, missed opportunities, and, ultimately, financial losses. By understanding the cognitive mechanisms, behavioral pitfalls, and psychological underpinnings of confirmation bias, we can begin to mitigate its impact. Cultivating a healthy skepticism, implementing structured decision-making processes, managing risk effectively, and addressing our emotional attachments are essential steps towards making more rational and profitable investments. Investing is not just about numbers. It's about understanding ourselves, our biases, and how they influence our behavior. By acknowledging the power of confirmation bias and taking proactive steps to mitigate its effects, we can gain a clearer perspective, make sounder judgments, and achieve long-term financial success. Your financial blueprint and success, along with your personal and professional fulfillment, matter to us. Remember to subscribe, like, and follow FA Juma Investor's Choice.